Welcome everyone to today's webinar. I'm Kieran Osborne, the Chief Investment Officer at Mission Wealth, and I'm really excited to be joined by Phil Hasbrouck from Cliffwater. Phil is a Senior Managing Director and the co-head of Cliffwater's asset management business. In his role, he leads the firm's asset management distribution efforts and is involved with product development and positioning. Phil has been instrumental in the development of Cliffwater's two private credit interval funds, the Cliffwater Corporate Lending Fund and the Cliffwater Enhanced Lending Fund, as well as the Cascade Private Capital Interval Fund. Many on this call will be familiar with the Cliffwater funds. Cliffwater is a key investment partner of Mission Wealth, and their strategies are a cornerstone of many of our clients' alternative allocations. Cliffwater is a pioneer within the alternatives industry, leading the development of interval funds. Their funds offer broadly diversified exposures to two of our highest conviction asset classes, private credit and private equity, and in very investor-friendly structures, providing our clients with access to asset classes that were traditionally reserved for large institutional investors. In my role as Chief Investment Officer at Mission Wealth, my team's responsibilities include research, due diligence, and investment selection, all of which underpins our broadly diversified investment portfolios. We've partnered with Phil and his team at Cliffwater for many years and hold them in very high regard. Today's market environment can best be described as uncertain, with trade policy dominating headlines and causing an uptick in market volatility. We've received a lot of questions on the current environment and the implications for the economy and investing, and we'll address these today. The start of this year has also underscored the importance of well-diversified portfolios that include asset classes that can zig when the markets zag. While the broad US stock market has come under pressure through the beginning of this year, many other asset classes have performed much better, including private credit and private equity, both of which are positive this year. Phil, I'd like to start with the economy, and we can dive into some fund level details shortly. Through the Cliffwater funds, you allocate to thousands of underlying businesses across all industries and sectors of the economy. What are you seeing in terms of underlying business fundamentals? What are you hearing from company management? Is the current environment as bad as the headlines are suggesting? And maybe if you can also touch on which sectors of the economy are more exposed and potentially more impacted by tariffs.
Sure, and thanks for having me on, Kieran. Today, the good news is things are never as bad as CNBC would have you believe. And it's always important to remember that this is when financial media gets their highest ratings. And they're going to hang on to that as long as they can and fan those flames as much as possible. Most of the economic data coming out right now is actually very strong. And there is speculation that things are going to be softening going forward. I think that speculation has some founding. But we'd kind of slow down and consider a few things. First, it's felt like 3 months, but we've really only been in this extreme volatility post, I think it was called Liberation Day, for 3 weeks. And an economy can only slow so much in 3 weeks. Yes, it's true that, businesses making plans on hiring or opening that next factory, where's it going to be? What are the implications of, my inputs that I'm purchasing around the world? All those things do slow down a little bit when you don't know the rules of the game. But the US economy isn't going to be upended over 3 weeks of uncertainty. And even during those 3 weeks, we should consider what the trend has been. Initially, it was massive tariffs on all of our global trading partners, effective immediately. And there's a lot of speculation about, is the White House posturing? Is this real? Is this what they call, escalating to de-escalate? And it appears that is the case. The reason we say that is after so many days of extreme volatility, all of a sudden it became clear the White House was really trying to focus the trade war on China, put a 90-day delay on everybody else, and then ramped up the tariffs and the focus on China, effectively saying, hey, they're a bad actor. This is who we want to focus on. So again, if you went back to Liberation Day and you're a company trying to operate who's buying imports from, Vietnam or Japan or wherever else, that day was a really bad day. And the next week might have brought a lot of uncertainty. And while a 90-day delay doesn't tell you everything, it tells you a lot, which is they don't want to upend the entire economy. They want to focus a trade war with China. So the rules of the game are already beginning to shift. Let's just keep pulling on this string. Today, the market's up, at least for now, because it seems the White House is extending some olive branch to China and saying, well, we don't think this is sustainable, and we could see tariffs being reduced by both parties, but it'd have to be unilateral, and kind of explicitly talking for the first time and saying, our policies are unsustainable. They need to change, and they will change. So as we think about this short period of time, which has been very emotional and the least fun I've had since 2020, the trend is pretty good in terms of us moving away from just smashing all of our global trade partners to focusing on China, to us now saying, can we start a conversation with China? And again, that goes back to, if you're a company today versus 3 weeks ago, you can have some more confidence that most of our global trade partners, and even China eventually, it appears we want to get on the right track with. I think one final thing to consider is how expensive the stock market was at the beginning of the year. Goldman Sachs, kind of made a lot of headlines saying they thought stocks would return, 2% over the next 10 years. We think stocks are going to return around 8% a year over the next 10 years. So we're certainly more bullish than Goldman Sachs, but everyone looked at the PE ratios, the common measurement of how expensive stocks are, and said, geez, things are good, but I don't know if they're good enough to justify these prices. So once we had a problem or a policy error, which a lot of people are considering it, you got a lot of downside volatility correcting off of what we call priced for perfection. So I think when we put all this together, Kieran, the answer is, the companies in our portfolio are fairly well insulated, and I'll talk about sectors during this presentation in a bit in a moment. We're not particularly worried that companies in our portfolio are saying, oh my goodness, we're fighting for our lives, our business been upended, our inputs from China were driving everything we do. And for the most part, companies are just saying, I really want to get solid footing on what the rules are if I'm going to continue to invest aggressively in my business, but it feels like we're trending that way. I think one part of your question was what kind of companies or sectors might be more or less impacted. A simple way to look at it might be, service-oriented companies in the United States, or technology-oriented, software as a service, et cetera. Those seem to be pretty well insulated parts of the market. We're focused on smaller companies, Kieran, that are less tied to the global supply chain. So while our average company might make $100 million a year, it's not like your Nike, where you've spent 30 years building out the most efficient global supply chains with the cheapest cost of labor, and you get these massive shocks that change the way you do business. Our companies, for better and for worse, just don't have that level of sophistication. They tend to be very US focused, both in where they manufacture their product or service and where they sell it. And so most people, taking a close look, have some confidence in private credit for that reason right now. I think where you'd want to stay away from, Kieran, and then I'll stop this little quick monologue, is we think about more impacted areas. We say consumer discretionary. And these are areas which were even considered riskier, ironically, before, like luxury goods or travel. Those things get more complicated in a tariff-oriented world. And if we have a recession, certainly consumer discretionary is tricky. And you really want to pick your spots there if you're going to have exposure. So those are the kind of two ends of the spectrum. But there's a little detail for you.
Yeah, maybe if we extend that a little bit further, and thanks, Phil, that provides a great perspective. Yeah, I mentioned earlier on the call, the Cliffwater credit funds and the Cascade Private Capital Fund are all positive year to date, despite heightened levels of volatility, despite the US stock market coming under a lot of pressure. This relative outperformance has certainly benefited our broadly diversified portfolios, allowing our clients to accounts to hold up relatively well in the face of increased volatility. But can you speak to, and maybe extend on what you just mentioned, what's driving that relative outperformance of both private credit and private equity year to date?
Sure. So with these private asset classes, valuation fundamentally is done differently than your liquid or your public asset classes. So to give an example here, if there's a trade in the market of a public security, then whatever that company is, whether it's a stock or a bond or a credit that you own, is going to be marked to the price of that trade. So no trading really exists in the private markets. And so instead, valuation is done based on really two factors. One, what are the comparable private market transactions that are occurring? So if one company was purchased at 20 times earnings, and then a highly similar company gets purchased at 18 times earnings, you could see a markdown in that first company because the private market kind of trades or new originations changed in value. But private equity firms tend to be much more consistent with how they kind of deploy capital over time. And look at it this way, that the stock market, I think, is trading at like 24 times earnings right now. Maybe it was 28, a month ago. Private equity firms, like in our portfolio, are buying companies at 13 times earnings. So in the private markets, you're just buying companies at much lower multiples. And therefore, when market multiples move, it isn't nearly as dramatic because they tend not to move as far. The other thing, private equity firms tend to, in bad markets, they'll still buy an exceptional company because they have a 5-year view. So again, you tend to have less volatility kind of in where transactions are getting done because private equity firms are taking a longer view. They're not saying, am I getting a great deal today that'll pay off next week? They're saying, hey, step back from the noise. Am I going to make 3 times my money in 3 to 5 years? And so again, longer view means less volatility in asset prices. So really, when we look at the valuation of private assets, it's what's going on in the private market ecosystem, where valuations and spreads tend to be much less volatile than in the public market. And then the other is company performance. So, we've had a number of companies in our private equity portfolio really outperform projections on what they were supposed to achieve on a year-to-date basis and over the last several months. So some of those positions have actually gotten marked up because they're outperforming. The same way, if you looked hard enough, you'd find some stocks that have been positive over the past month because aside from all the issues with the market, some companies are doing exceptionally well. So again, I don't think there's anything unusual. And Kieran has been investing with us for over 5 years. We went through 2020 and our funds behaved highly similar to this. I think 2022 was a year stocks and bonds both finished down about 15%. Our credit funds, depending upon which one you were in, returned between 6 and 10%. So to come around to it, when markets are bad, we are going to mark down our portfolio if we so that we don't get caught flat-footed as information comes in. So it's not as if we're having a banner year right now. Our credit funds are only up 2 to 3%. Our private equity fund is up modestly. So things aren't great because we're conservative on the valuations, but we're still not stuck bearing the full brunt of the volatility of the stock market because there is no trading, and that's not how these assets are valued.
Yeah, that's helpful. And then specific to private credit, how is the current uncertainty, the current investing environment associated with trade policy likely to impact availability of credit and your expectations around default rates moving forward? And then how are the Cliffwater credit funds positioning themselves to mitigate any negative impact from current uncertainty?
Sure. So most of the good news for us, and this will be in the deck I go through, is our first and greatest line of defense, as boring as it sounds, is diversification. And I know that's maybe like a yawn or an eye roll for some of the listeners, but these are the moments when you really want diversification, because let's face it, like some companies are just unlucky right now. If you were buying all of your products from China to resell in the United States, or selling into China, or buying a lot of inputs, it's a really unlucky circumstance for your company right now. Our portfolios are among the most diversified in the world in the respective kind of categories. Now, what this means is when things like this occur, idiosyncratic risks, we're going to be impacted to some extent. But will we have any meaningful impact that's really going to change your long-term expected returns? It's unlikely. So being hyper diversified, yes, you're going to take a little medicine because some of our companies are going to have some issues, but you don't need to worry about Cliffwater having a 5% position that's in trouble, because our largest position is in fact 60 basis points or something. So that's kind of the first line of defense. I'd say second to that, we'll go through it again in the presentation. We think we're about, whether you're looking at credit or equity, we're pretty much 80% in the sectors you want to be in, 20% of the sectors you might not want to be in. But when we kind of put the microscope on those, we'll get into why we think we're going to do just fine, even in the less favorable sectors. On the risk of default rates going up, look, the less growth, and if we are in a period of kind of higher rates and slower growth, we should expect default rates to rise. Default rates rose 400% in 2020 across the private debt market. 400%. That's a great like CNBC headline. But the real story is our fund returned 8.5% that year. So, what happened? Well, just because the market had default rates go way up doesn't mean our fund did. And two, even when you have defaults, companies cure them, companies start performing again, loans get restructured, and most of the issues in the portfolio just get wiped away by high yields. And so even if you have some credit losses along the way, you can do all right. 2020 again, Kieran, or 2022, you probably remember, interest rates went up about 5% that year. And everyone was worried, how are these companies going to pay 5% extra? It's going to cause them all to default. What it actually set up was, a multi-year period of double-digit returns, because companies adjusted. Yeah, defaults went up a little, but you got paid higher yield because of higher interest rates. So I would say we always want to be eyes wide open. Defaults in bad economic periods will go up, but you shouldn't make the assumption that means you're not going to be really happy with the absolute return generated in these funds. Especially, again, 2022, you could look at our flagship fund, which had its worst year at 6.5%. Is 6.5% that year a bad year for our fund, which has done 9.5 on average? Yes. But was it really good relative to stocks and bonds, both down 15? Yeah, maybe that's actually more valuable to you than us being up 12 when the market's up 30. So everything is relative. And if we're moving into a tougher economic environment, I actually think people are going to appreciate more the absolute returns that can be generated in private credit and in private equity. And, as we get into the presentation, we'll talk about some of the more opportunistic things. But the general theme we see, Kieran, is less business activity does mean less origination opportunity in terms of what's out there. The good news for us is we're multi-manager, we're open architecture. So it's not really up to Cliffwater to run around looking for the best deals that are in the market on a given day. It's up to all of our 30 or so investment partners, who are the top fund managers in the world, to go hunt for opportunities. So the opportunities that'll be found in a market like this will be very attractive, but they will be scarce. And again, that's where we like our model, because we have so many different avenues into the market that we're due to find opportunities through our investment partners.
Yeah, Phil, we've received a lot of questions, unsurprisingly, around like downside risk and what are the downside risks given the heightened level of uncertainty that we find ourselves in today. But can you speak to downside risks for both private credit and private equity? I know you probably have a slide that speaks to this, but what does a really bad year look like? What does a skies falling sort of catastrophic downside event like a 2008 scenario look like for private credit and private equity returns?
The only good news about 2008 is we all have a kind of model now for the worst recession we saw in 100 years, since the Great Recession previously. So the first thing I'd say is, 2008s are what we would call 2 sigma or arguably 3 sigma events. So it's always fine to underwrite to the 100-year recession. Just remember that you're likely not underwriting to an accurate recession. You're likely being much more severe. With that in mind, I'll just give you some plain statistics. Private equity, broadly speaking, returned minus 27 in 2008, when the stock market returned minus 37. So outperformed the stock market by about 10%, but you did see a substantial drawdown. If we kind of look at 2022, not a recession year, but a market correction, which, by the way, in terms of magnitude, people don't like to talk about it, was more serious than what we're dealing with today. The stock market returned minus 18, private equity returned minus 9. We think we're running a more conservative private equity portfolio and would expect less downside risk. But I would think about private equity this way. We're trying to earn a 3 to 5% premium for you over your public stocks over a full market cycle. And that's kind of what the premium has been historically and what we think we can do. Again, 3 to 5% a year. It's not going to be 3 to 5% every single year, year after year after year. So if we're going into a really bad downside scenario, you will likely have a chance for more outperformance relative to your stocks. Maybe you'll outperform your stocks by 10%, like in these other periods I described, instead of 3. The same is true if we're all wrong about all this, by the way. It wouldn't be the first time in history that the whole market kind of coalesces around a certain outlook, and then out of nowhere, stocks are on the march again and they're up 40. If stocks are up 40 over the next year, our private equity fund is probably going to be up 25 or 30. So it's not going to keep up with the stock market in the hottest environment, and it's not going to go all the way down with the stock market in the worst environment. It's going to be somewhere in between, and it should blend to 3 to 5% over stocks long term. When we think about private credit, you have a better shot for what we would call absolute returns, because you're at the top of the capital structure, because you're less sensitive to earnings and growth. You have a better chance of generating a positive return in any environment, but without the same upside as private equity. So to talk about private debt specifically, in 2008, private debt returned minus 7%. That minus 7. That is the only negative year in the history of the asset class. And I would also mention that the asset class at the time, this is a detail but an important one, was 70% junior debt, junior in the capital structure, kind of halfway between equity and senior debt. Today, we're 95% senior debt. So we're positioned much more conservatively than kind of that market return I just described for you. But again, if you want a worst case scenario, I'd look to 2008. Again, private credit would be down 7% versus a long-term expected return of about 9.5%.
Great, thanks, Phil. Moving forward and just looking at, the economic outlook, the economic forecasts, the base case really does appear to be in an environment with heightened inflation generated by increased tariffs and moderated economic growth based upon the current uncertainty associated with trade policy. The chances of a recession are certainly elevated. In this type of environment, how do you expect private credit and private equity to perform relative to public stocks and bonds?
Private credit, well, I think the headline is, again, if you remember something coming away from this webinar today, it's that when things are really bad, private market returns are going to look very good relative to public market returns. And when things are really good, public market returns are going to look really good relative to private market returns. So I would argue if you're fearful, or maybe we'll use the term cautious or conservative, speculating on the future of the public markets is going to be a much more volatile bet than being in private markets, where again, you're buying companies at much, much lower multiples, and where on the credit side, you're getting a lot more yield to kind of get you through any tough times. So again, higher inflation and moderated growth is not generally good for earnings. I would say the positive, and for credit, do we care about earnings? Yes, we care. What we really care about is defaults. So the good news is higher inflation probably means rates stay higher. If rates stay higher, we have more yield. More yield is your best defense versus credit losses. And as I alluded to earlier, over the last couple of years, default rates went up a little bit, but nobody noticed because the coupons you were clipping went up so much. So we like the opportunity for private credit to generate good absolute returns, certainly over public market credit and bonds, if we do have inflation. If the inflation outlook worsens, by the way, we could be looking at a 2022 type scenario where you've got negative stock returns, negative bond returns, but private credit can still give you kind of a mid to high single digit return and becomes a really valuable part of the portfolio. I would say on the private equity side, you are going to see more downside pressure than private credit just because you're taking more risk in equity than you are in credit. The one encouraging thing we'll talk about during this webinar is the opportunity in the secondaries market. And when things get really volatile with financial markets or with the economy, we can be more opportunistic in private equity and make investments that really generate outsized gains, which isn't as easy to implement in credit. So we think that'll be an important offsetting feature and something that might surprise folks on the outperformance that could be achieved in private equity, even in a tough economic environment.
That's super helpful, Phil. Look, we've talked a lot about downside risk, and you alluded to opportunity set. Given the current uncertainty, is that generating enhanced investment opportunities for your private credit and private equity oriented strategies? How are you going about investing given the current uncertainty? And do the structure of your funds allow you to go on offense in times of stock market duress or broad market duress?
Yeah, so our funds have outperformed almost all of their peers, not because we're the smartest guys in the room, but because, frankly, we keep the fees really low compared to our peers. And then we partner with the best investment managers in the world in a multi-manager fashion. So Blackstone may offer 100 strategies today. There might be 3 strategies we think they're exceptionally good at, and we're going to partner with them just on those 3. And then we'll move to KKR and say, we think they're the best at these 2 and partner with them there. So again, being able to partner with managers across the market and telling them to specialize in certain things for us has really been helpful. I think we try to position ourselves conservatively. Our funds collectively have I'm just running the math in my head, probably $5 billion of liquidity that can be deployed today. So the reason we do that is, one, if you do want your money out at the end of the quarter, we can get it for you, at least have good odds of it without having to sell any assets. And number two, so that we're in a strong position when things soften a little bit. And that's where we are today. Again, we're going to discuss it more, but we're not taking the approach of let's wait and see what happens. We're trying to take a long view, saying, okay, everyone's skittish right now. You've got some forced sellers of different assets, even in the private market. Maybe we should step in and be the liquidity provider. And that's worked really well for us in the past. The best investments we've made in our funds over the last 6 years have been in really bad periods, which shouldn't surprise anyone. It's probably the best time your viewers and you have made your investments too. So the good news is we've got a lot of liquidity and we've got a long view on the markets. So we want to step in and provide liquidity when others are fearful, or when a lot of managers, frankly, just say, hey, life's good. I'm not going to do any investing. I'll just sit on my hands and wait for the clouds to clear. We don't really want to do that. We want to kind of constantly be in the market and not try to trick ourselves into thinking we can time things. Again, a little bit on us. Kieran gave us a nice warm welcome. Our firm today has almost 200 employees across the country. We've been in business 20 years now. We have two businesses. One, providing advice for some of the largest institutional investors in the world on their alternative investment portfolios. That's where big sovereign wealth funds will come to us and say, hey, who's the best manager doing this specific strategy? Can you make recommendations, or can you help me build a portfolio? That's our advisory business. In recent years, we've really started to focus on the fund management business, where we're using all the intelligence we collected over 20 years investing in private markets and discovering who the best managers were to launch these multi-manager or open architecture funds across credit and private equity, which allows somewhat of a turnkey solution for investors who partner with RAs like Mission to plug into asset classes where we think we can offer the best execution, the best managers, the most diversification, and surprisingly attractive fees. Tiffany, you can lead to the next slide, please. This is why we're in business, and this is what we're all talking about. So over 20 years now, the Cliffwater Direct Lending Index is the private credit or, private debt index. And the appeal of this asset class, up and down, we're looking at return. Left and right, we're looking at volatility. So you can see this asset class has generated a return almost on par with stocks at 10%, but with volatility that's actually lower than traditional bonds, or as we would say, a standard deviation of less than 4%. And so we call that the Northwest Quadrant, kind of the holy grail of investing, is finding high return, low volatility asset classes that can really be complementary to traditional stocks and bonds in a portfolio, and we'll touch on that. Private equity, if you're a real long-term investor, and if you are concerned with tax consequences, which are one of the holdbacks of private credit, private equity is, for the long-term investor, the king asset class. The returns are the highest. Again, you're buying companies at much cheaper prices than you are in the public market. And that's led to, depending upon the period you look at, 3 to 5% outperformance over the public stock market. It is more volatile than private credit, certainly, but it is, as we discussed earlier, on the upside and the downside, about 40% less volatile than the public stock market. You can proceed, Tiffany. We have 3 funds and try to run a small platform in terms of offerings and hopefully do it really well. On the far left is what we call senior direct lending. This is making loans to companies who make about $100 million a year in profits, and companies that are probably worth $1 billion. They're just not publicly traded. And these loans are all floating rate. So the easiest way to think about it is we're trying to earn a premium of over treasury bills, I always say, between 5 and 7%. We can see historically it's been about 7%. But someone will say, well, what happens if rates get cut? Well, okay, your money market yield goes down 25 basis points, your Cliffwater yield will go down 25 basis points. What if there's inflation and rates go back up? Okay, your money market yield's going to go up 25 basis points, your Cliffwater yield's going to go up 25 basis points. So just think of this as senior lending product that's massively diversified, where we don't have a lot of downside risk, and where we think we can get a 5 to 7% spread over treasury bills. Highly vanilla product focused just on lending at the top of the capital structure. In the center is our broad-based private debt fund, our enhanced lending fund. Here you are giving us more latitude to take risk. Instead of like in our flagship product where it's really, hey, stay senior, stay diversified, lend to companies, nothing too fancy. In the middle fund, it's really more handing the keys to Cliffwater and saying, you should go pick the appropriate level of risk to take. And we're going to get into other areas of the private debt market as well. Asset-based finance, where you're lending against hard assets, is a growing theme in the market where we can generate higher returns. Investing in royalties, royalties associated with pharmaceuticals or music or other forms of media is another area of the private debt market we like, where we think we can generate outsized returns. As you can see here, when given a little more latitude, we've been able to generate returns about 9.5% over treasury bills. So if you have a risk appetite to do something in addition to or in lieu of our flagship fund, which is in a very tight box, and to give us more latitude, we think we can generate higher returns for our investors as well. And then again, on the far right is our private equity fund. We think we're going to continue to see some pretty vast outperformance. The generic spread we're looking for over public equities is 3 to 5%. One thing I alluded to earlier is that in really volatile environments, the relative returns we can generate are actually much more attractive. And over the last couple of years, stock market returns have been good, not great. And we're seeing that again this year. So this is a substitute for your equities. You should not be viewing it as a low vol product like our credit funds. You should be looking at it as, I can get a higher return than in public equities over time, and I'm going to have less volatility, but still some. Again, about 40% less volatile than the stock market, but not nearly as low in volatility as our credit funds. The tax treatment, it is vastly superior, of course. There you're looking at all long-term capital gains versus income, which of course is a consideration Mission can help you make. You can continue, please, Tiffany. Okay, so, I wanted to talk about tariff exposure. Again, we kind of touched on this with Kieran, so I won't belabor the point too much. I'll do the quick math for you. Our funds are kind of 80% or so in the less impacted sectors, 20% in the more impacted sectors. What makes a sector, again, less impacted? Technology, again, a CRM service being used in the United States isn't going to get displaced because of tariffs. So services are a good place to be. Right now, I think, in contrast, if you're manufacturing things, it can be more complicated with global supply chains. There is an overlay to all of this, which again is the biggest and most sophisticated companies that have built out the most extensive global supply chains are the ones who are getting hurt the most right now. And those are mostly public market issues. A widget maker in the United States that sells widgets to other United States consumers is pretty well insulated, unless they have some very heavy reliance on China, which could be causing problems for them. So again, we're not going to go unscathed through this tariff thing. We're just proposing to you that it's not really going to change your expected returns because we're so diversified. Going down to the consumer discretionary area, again, there's pockets that we're really focused on that have done better, or that we expect to do better. Auto collision centers. These tend to be not too cyclical. Someone has a problem with their car, they need a car to drive, they're going to get it fixed. Education is another area that we're invested in. I don't like to bring it up, except that it is, again, an acyclical area, but like pet cremation. There are corners of the consumer discretionary market we're in that we've been looking for that we always thought would be less cyclical. We never imagined we'd have these tariff issues, but we're always trying to think about the next recession. Now, there's no free lunch out there, which means we've had to accept more conservative returns in those areas than we could have gotten in travel and leisure or luxury goods. We think those are some of the worst areas you could be right now. A $5,000 handbag made in China isn't going to do very well with tariffs and with a recession. Now, again, the answer isn't that we're smarter than everyone. Someone else got paid a lot more money to make that loan to the handbag company. But that was the risk they were taking. It was a recession risk. Now the tariff risk kind of comes on top. So again, kind of key takeaways. Not here to tell you we're going to have zero exposure to any of this. We're just saying that we feel really good because we're generally in the right sectors. We're generally focused on businesses that have not built out major global supply chains. And we've stayed away from the most cyclical sectors, which ironically are the ones we think are going to get pinched the most by tariffs if this actually ends up being a going concern. For all we know, we could have a trade deal with China in 3 months and go back to find a new topic to talk about. Next slide, please. Again, diversification sounds boring, but these are the times to be happy you have it. We're just looking at our credit funds here. Our equity fund is similar. On the right side, you can basically see that a BDC is just the common kind of evergreen wealth management vehicle for private debt. They're not fundamentally bad. They're fine. But you can see the average, think of it this way, the average private credit fund, has their top 10 credits make up 35% of the portfolio. For us, our top 10 credits make up 5 to 7% of our portfolios. So we're much more diversified. And all this should mean for you, I don't love the expression, except that during periods like this, I, with my own portfolio, think about it. I don't sleep at all at night worried about having some big downside risk in our funds. We're not positioning these funds to outperform everyone in the market. We're too diversified, but we are positioning them in a manner where the expected return should be pretty reliable and where our diversification, should give you comfort during tough times. Next slide, please. We touched on this. What's the downside risk in private equity? And this is all stuff, particularly index data we can share with Mission, and Mission could, I presume, share with you circumstantially. We think that we can outperform these private equity index numbers for reasons we'll get into in a little bit. But this should paint a picture for you of kind of why you should be taking away from public equities to do private equity. On the right side, you can see the long-term 3% premium that the market's provided. By the way, that's the market return. If we're good at picking managers and doing our job, we should be able to increase that spread substantially. And then on the left side, you can kind of see in recent downturns, you don't have the same kind of downside risk that you have in public equities. If you inspect the page further, let's all look at 2008. Okay, so you outperformed public equities by 10%. We didn't label it, but look at 2009, and public equities really outperform private equity, but private equity does start to rebound. Again, it's less volatility in both directions. A lot of people like to pontificate about, private markets aren't marking properly. It's the public markets that have it right. I don't know that that's true. Like, the public markets were so rational, they wouldn't be so volatile. So ultimately, remember, your private equity managers are taking 3 to 5 year views. We are as well. That's how we're going to earn that long-term premium for you. It's not about outperforming every day or every month. It's about the premium we can build over a cycle or 3 to 5 years. Continue on, please. Here I compare our Cliffwater Direct Lending Index. Again, this is the market. I alluded to earlier, 2008. we can see the market return for private debt, albeit it was a riskier market then, was -7. Now bonds were up 5 that year. Traditionally, we've all thought that bonds were a hyper reliable hedge to stocks. In 2008, they were pretty good, but we zoom ahead to 2022 and it didn't work because rates went up. So again, it makes sense to own bonds in your portfolio because if rates do go down, those bonds will appreciate. But if rates actually go the other direction, you're going to lose money in your bonds, and the kind of hedge versus stocks can be unreliable. And I think this is one reason Mission has really emphasized not just having a stock and bond portfolio, because that hedge from bonds is only working half the time. Historically, if you add private credit in as well, you have something that can perform as rates go up. And so it's a nice complement to traditional bonds in a portfolio where you're almost inevitably going to have something performing in any environment. And if you as clients need liquidity, you certainly don't want to be selling things when they're down. So I think private debt provides a really nice hedge if bonds aren't performing. Forward again, please. I'll just go over these slides quickly. On the left, we have, since this fund launched 6 years ago, our flagship fund. The average period where the S&P 500 was negative, the S&P returned -4%. In those same periods, at least over the last 6 years, the average return for bonds was -1. So bonds have not, on average, been working very well as a hedge to stocks over the recent period. And you can see our flagship fund doesn't have its best month, when stocks are sharply negative, but returns 58 basis points. And on the right side, we can look and say what's happened when bonds are negative. Well, when bonds are negative, on average, they're negative to the tune of 1%, and stocks have been following bonds. And in those periods, our fund has actually done really well, returning about 70 basis points in those months. So again, I think it's a really important part of a portfolio today to have private credit, because it complements so well the return streams from from bonds and stocks, and kind of bails you out when bonds don't deliver for you. We can move forward. This is a similar page we don't need to go through with another fund of ours. Next slide, please. This is my favorite slide. Unfortunately, there's going to be, private credit is the fastest growing alternative asset class in the world right now. As a result of that, it's one of the most written about. And there's not a lot of money writing stories about, everything being fine, or it's okay if defaults go up, the returns can still be good. So you get these kind of wild stories, and we can read this together. Like, I'll just point out, in January of 2020, high yield was oxy, private credit is fentanyl. And then you kind of roll through to all these ridiculous headlines, to one which I was able to grab. I like updating this month. Cracks are forming in private credit, what to know. And you just kind of, we've seen these same charts built for stock market returns over time. And I feel the same way about stocks as I do about private credit, which is there's just a lot of money to be made trying to convince investors that they're missing something. And there's no money to be made telling investors, invest for the long run, let your advisor do their job, and look at the long-term data. So, ultimately, I guess the good news I have for you is we have a lot of confidence, and our monies at Cliffwater are almost entirely invested in our own funds. We have a lot of confidence in what we're doing, and that this is low risk investing. The bad news is the headlines will continue. So hang in there, and hopefully you'll continue to have as good of an experience as you've had the last 6 years while the media has tried to convince everyone the asset class has problems. And then I think we may have one final slide here. We've talked a lot today about what could go wrong, and risk management obviously is paramount. But there are going to be opportunities if things get better in markets. Let's all feel good about that. Okay, That means the economy is going to do better. It means your stocks and my stocks are going to appreciate. It means you're going to see solid returns from our funds. But as and if things get bad, we really think we're in a pretty strong position to capitalize. Again, the hardest thing in a bad market, great deals get done, but there's so few of them. So if you have an open architecture platform like us and you're partnering with 30 managers per fund, we've got a lot of lines in the water, to use a fishing analogy, and we have a great opportunity to sift through a lot of different investments, pick the ones we like the most, and to actually get deals done in a market that's very difficult. One kind of theme I will highlight for you is a secondary market, and the secondary market is where investors are trading their private fund interests at a discount typically. So let's say I signed up for a 10-year private equity fund. I don't like what's going on in the world. I need money. I might be willing to sell that private equity fund, even if it has no problems, at a 20% discount because I personally am in a jam. Now, let's take me personally out of it and my financial problems out of it. One kind of bigger issue today, which politics aside, we take no view on, a lot of folks are very focused on endowment uncertainty, tax status, freezing of government grants. This could, again, White House could retreat. It wouldn't be the first time. This could put a real squeeze on the biggest investors in alternative investments, university endowments. And it wouldn't be surprising if they went to the secondary market to sell some of their assets because they have a financial burden they weren't expecting as an organization. They want to generate some liquidity. So again, our funds have a lot of liquidity right now. We're not relying on government grants or tax treatment to run our operations. So, Yale is bringing a $4 billion private markets portfolio to market. We'll be looking at pieces of that, and we expect more of that to come. And if we can buy high quality assets at a discount, especially assets that are going to continue appreciating over time, these are the sort of opportunistic things that can get done where we capture inefficiencies in the private markets, and where we might be able to turn what would otherwise be a kind of tough year into a really promising one. I'll stop there, Kieran. That's all I kind of had prepared, and treat the rest of the time as you'd like.
No, this is great. I think this has been super helpful to cover all these slides. I have one last question I want to leave you with, leave the group with here. And that is, you've covered a lot of data, which, depicts the compelling risk-adjusted returns of private credit and private equity relative to, public market equivalents. But if we think about, the next decade ahead, are you confident that private credit and private equity will outperform public markets, whether it be public equities or public credit or the broad bond market? And why is that, if you do have that confidence?
Yeah, we'll start with credit. Is our CIO, Steve Nesbitt. He's probably the smartest person I've met, but he seldom says anything that's concise. But as he says with credit, the yield is there. And all he means by that is our fund has a yield to maturity of about 10%. But if you go to if you want to buy treasury bills right now or money market, you're probably at a 4% yield and change. If you want to buy liquid loans, you're probably at a 6 to 7% yield. So fundamentally, the yield we're delivering is higher. The follow-on question is, well, what about credit losses? And can Cliffwater avoid credit losses relative to the liquid market? Historically, our credit losses have been lower than the liquid market, and there's no evidence over 20 years that the liquid loan market, despite having yields that are 300 basis points lower, has any higher quality kind of credit characteristics. And that's what CNBC doesn't report, either because they don't know or it's not interesting, is there's a ton of data. And it's pretty simple. You get paid more yield to give up liquidity to go into parts of the market not everybody can. The less crowded the market you're in, the higher your returns are going to be. Less competition, higher returns. And as I look at private equity, you know, this has been the age-old conversation. And every time the stock market has a good year, you know, the Financial Times will write a story, or Bloomberg, oh my God, you know, the S&P 500 clobbered private equity last year, S&P up 40, private equity only up 25. You know, you can't look at one year. You've got to look at the long-term premiums. And one might say, well, what's driving that? Again, our private equity portfolio for our fund has a price to earnings ratio of about 13 times. The stock market is well over 20 times price to earnings. So it just, you know, that's kind of the king measurement of how expensive your portfolio is. And I'll do you one better. Small companies grow faster. And it's not because they're better. It's just a lot easier to go from making $50 million a year to 200 than to go from 50 billion to 200 billion. You need experts picking the right companies. There's more risk when you are dealing with a middle market business. But when you talk about a much more attractive entry point and the potential for higher growth, it becomes a lot simpler to wrap your head around why returns in private equity have been so much better. So Kieran, the reason I still have confidence in credit, the yield is there. We can see the premiums clear as day. And in private equity, our portfolio is so much cheaper than what's in the stock market that we should be able to outperform over time.
Thank you so much for your time today. It's an absolute pleasure to have you share all your expertise with us. And thanks everyone in attendance. I hope you found this webinar helpful in providing valuable insights into both the private equity and the private credit asset classes.